So what's our take on this market? In an economy such as ours, innovation and openness create tremendous opportunities for success in virtually every line of business. In financial services, deregulation and innovation have, to some degree, created a vast array of new products and brought in many new participants. Banks have realized economies of scale and the benefits of diversification. Derivatives and securitization have provided flexibility, enabling risk-based asset pricing. And notwithstanding the current problems we're having with the securitization market, I think we should not forget that these product innovations did give us 15 years of the golden age of American banking. Like any banking supervisor, we welcome innovation that improves bank liquidity, provided it does not impair capital or operational positions. For example, the FDIC has a lot of experience dealing with securitization. The FDIC and the old Resolution Trust Corporation, and others remember that, helped clean up the savings and loan crisis of the 1980s, and that did a lot to develop the market for mortgage securitizations during the early 1990s. That demonstrated how the financial markets could be a key tool for enhancing liquidity in mortgage markets. Later, the FDIC helped clarify the rules governing the market by providing regulatory guidance about the protections for securitizations when a bank fails. Our job, first and foremost, is guarding people's money with the Deposit Insurance Fund. That's why we were created 75 years ago, to help reestablish public confidence in our banking system during the Great Depression. We've had virtually no bank runs, and it's because the public is confident that their money is safe in a federally insured institution. When a new product or innovative market strategy hits the market, we have certain key questions, and we're asking these right now to cover bond market. First and foremost, what kind of impact will it have? How will transactions function during periods of financial stress? We've seen suggestions in Europe that maybe we're seeing a little bit of job with covered bonds. Does it put the deposit insurance fund at greater risk if a bank fails? How does it affect the failed bank's depositors? How will it affect the risk of the banking system? And do we need to take any action or consult with the other banks and regulators? What about covered bonds? As I say, we welcome innovation, particularly when it has the significant potential of another tool for liquidity. However, I'm sorry, at this stage, we still want to better understand how they work and how they might impact the potential risk to our insurance fund and resolution funds. We'd like to know if they will improve market discipline or raise underwriting standards. And I think that may be a good argument and to pursue that aspect of it. It could be very positive from a regulatory perspective. Our recent experience in the subprime market obviously has demonstrated that the originate and sell model can create perverse incentives because of the mistaken belief that securitization transfers all risk to others that can lead to weaker underwriting, as we've seen. By contrast, if the lender originates loans that will continue to hold on its balance sheet, it may be more careful. If covered bonds allow banks to retain originated loans while accessing financial market funding, this could be a very positive development. The covered bond market in the United States is still in its infancy, so there's still we're at the stage of asking questions of great as opposed to drawing conclusions. But we look forward to getting more information and to evaluating comparative risk as the market continues to develop. Finally, I would ask that whatever your involvement with this new product, be it steelmaker, investor, what have you, please be responsible and be transparent. You know, you want to make money, and that's what capitalists do, and that's all good for an free market economy. But our mortgage and credit markets are in turmoil today, as we all know. The housing industry slump affects neighborhoods, homeowners, investors, the markets, and even the broader economy. So, and unfortunately, it's largely because of poor underwriting practices that was facilitated by a breakdown in market discipline. The eagerness of investors to buy mortgages led to almost no price difference between more risky and less risky mortgages, and the originate and sell mentality led, unfortunately, to weaker and weaker underwriting standards. So I would ask that in making your own deals, whether they be covered bonds or otherwise, or in making your own investment decisions, that you seek out good investments that are backed by responsibly underwritten mortgage loans or other assets. If your investment decisions focus on sustainable mortgages, then your investments are more likely to perform, and the mortgage market volatility we have seen will be less likely. I believe this is in everybody's best interest, lenders, investors, and borrowers, and certainly in the national interest. What's at stake is truly the health of the U.S. economy. The ability to build wealth and preserve the American dream of owning a home, of which you've been an integral part, means living in stable, productive communities and neighborhoods across the country. This is something we all want. So, thank you very much. That concludes our presentation. I'll be happy to take your questions.